Hi everyone, welcome back to Corporate Jogger, the place where we break down the nuts and bolts of business and stock market news with a twist of brutal honesty. Get ready because Hooker Furnishings Corporation just dropped their latest report, and it's a story of shrinking sales but also some interesting moves behind the scenes. Before we dive in, if you're tired of the corporate jargon and want clear, unbiased financial insights, make sure you're subscribed right now. And hey, join our Discord community linked in the description for even more real-time market talk. Alright, so Hooker Furnishings Corporation is a company that makes furniture, like sofas, tables, and all that good stuff. They've just released their quarterly report for the period ending August 3, 2025, and it gives us a peek into how they're doing. First off, let's look at the big picture. As of August 3, 2025, Hooker Furnishings had total assets of $278 million. Now compare that to February 2, 2025, and it was $313 million. So their total assets shrunk by about $35 million. That's a noticeable decrease. Now let's talk about money coming in. Trade accounts receivable were $41.3 million at the end of August 2025, down from $58.1 million. This means they collected money from customers in the last quarter, which is generally a good sign, but it also reflects fewer sales. Inventories are also down. They were $58.5 million compared to $70.7 million. This shows they're trying to slim down their stock, which can be good if sales pick up, but could mean they're anticipating slower demand. When we look at how much it costs to make and get their products to customers, that's the cost of sales. For the 13 weeks ending August 3, 2025, it was $65.3 million. Compare that to the same period last year, July 28, 2024, and it was $74.1 million. So their cost to sell stuff went down by almost $9 million. This makes sense because their sales were also lower. This difference between sales and the cost to sell is called gross profit. Hooker Furnishings made $16.8 million in gross profit for the last quarter. Last year it was $20.9 million. So their gross profit also went down by about $4 million. Now, what about the other costs like running the offices, marketing and management salaries, that's selling, and administrative expenses? For the quarter, it was $20.3 million. Last year, it was $23.1 million, so these costs also decreased by about $2.8 million. They are actively trying to cut costs, which is a smart move when sales are down. When you put all that together, you get operating income, or in Hooker's case, an operating loss. For the second quarter of 2026, they had an operating loss of $4.4 million. Last year, it was a loss of $3.1 million. So the loss actually got a bit bigger. This is partly because of those cost-cutting efforts, including restructuring costs, which are like one-time expenses when you're making big changes. And the bottom line, the net loss for the quarter was $3.2 million, meaning they lost money. Last year, they had a net loss of $1.9 million, so the net loss widened. Let's look directly at sales. Consolidated net sales fell by 13.6% to $82.1 million in the second quarter of fiscal 2026. This is compared to $95.08 million in the same period of the previous year. This drop is mainly because of a really big hit in their Home Meridian segment. Sales there dropped by over 44%. The Home Meridian segment is feeling the pain. The report says this segment of their business is for value-focused customers, and they're being hit hard by economic problems like inflation and generally less consumer spending. Plus, there are these tariff issues which make customers hesitant to buy. On top of that, they lost a big customer who went bankrupt last year. So Home Meridian is really struggling. The domestic upholstery segment, however, showed a little bit of life. Sales were pretty much flat, but they saw some good signs in their indoor furniture business. Their outdoor furniture business, however, is down a bit, likely due to supply chain hiccups. The Hooker branded segment, which includes their main Hooker cash goods and Hooker upholstery businesses, also saw a modest increase in sales. It grew by just over 1%. This is a positive sign that maybe their high-priced products are holding up a bit better. Looking at gross profit, the difference between sales and the cost of those sales, we see a decline. Gross profit dropped by $4.1 million in the quarter. This means that even though they cut some costs, the lower sales and some other factors like higher product costs hurt their ability to make money on each sale. The gross profit margin also slipped. They did manage to cut selling and administrative expenses across the board by about $2.8 million in the quarter. This is thanks to their cost reduction efforts. In fact, they're working on a plan to save about $25 million annually. These cost-cutting moves come with immediate costs, known as restructuring costs. In the second corner, they incurred $2 million in these costs. This included expenses for things like employee severance and consolidating warehouses. For the first half of the year, these restructuring costs totaled $2.5 million. Let's talk about orders. The company's backlog of unshipped orders was $51.1 million at the end of August 2025. This is down from $52.6 million at the start of the year. The Home Meridian segment saw a big drop in orders, while their domestic upholstery and hooker branded segments had increases. Interestingly, their orders in July were up quite a bit compared to last year, which could be a positive sign for the future. The company is really pushing to cut costs. They're in phase 2 of a plan to save about $25 million a year. This involves closing a warehouse in Savannah, Georgia, and optimizing their operations overall. They're also using a new warehouse in Vietnam, which is helping them deliver products faster and more efficiently. This new warehouse in Vietnam is a big deal. It's helping them shorten the time it takes to get products to customers dramatically. This should help them manage inventory better and serve their big clients more effectively. Now for cash flow. For the first 6 months of 2026, they actually generated $18.1 million in cash from their regular business operations. This is a big jump from just $5.3 million in the same period last year. A lot of this improvement came from collecting money faster from customers and reducing inventory faster. These are good signs that they are managing their working capital more effectively. However, they used a lot of cash for financing activities. They had $21.5 million in outflows compared to $5.6 million last year. This was mainly due to paying back money they had borrowed. Their overall financial health relies on managing cash, managing inventory, and managing their debts. They have a credit line of up to $70 million, which is important for their operations. Looking ahead though, managing cash is key. They need cash for day-to-day operations, paying rent and employees, and also for things like showroom upgrades and improving their technology. They also have a revolving credit facility with a bank, and their loans are tied to this interest rate known as the term SOFR rate. A small increase in this rate could cost them an extra $56,000 a year in interest. So what's the outlook? The company is trying to get back to being profitable by cutting costs and focusing on sales growth opportunities in areas like hotels and businesses, and with their new outdoor furniture. They acknowledge that the market is tough with lower home sales and high interest rates impacting consumer spending. They expect things to get better for the Home Meridian segment by the end of the year, but it's still a challenging environment. Now for my take, Hooker Furnishings is clearly in a tough spot with declining sales, particularly in their value-focused Home Meridian segment. They are doing the right things by cutting costs and optimizing their operations with things like the Vietnam warehouse. This shows good management in a difficult market. The increase in orders recently at their other segments is a hopeful sign. However, the overall industry headwinds are significant, and it's going to take a lot to turn things around completely. Their debt is manageable, but their ability to generate sales is the main question mark. They are managing their cash better, which is a strong point, but they need to see sales growth to really get healthy again. Alright, that's our breakdown of Hooker Furnishings' latest report. What do you think about these numbers and their strategy going forward? Do you think they can turn things around? Let me know your thoughts in the comments below. If you found this video helpful and enjoy getting straight to the point insights, smash that like button and subscribe for more of this kind of content. And hey, don't forget to join our Discord community, linked in the description for more market discussions. Thanks for watching, and we'll see you in the next one.